All right, let's dive into Basel IV fee today. We've got excerpts from Anand Vemula's Basel V guide.
It's a dense topic,
Yeah,
but important.
yeah, definitely a lot to unpack.
But I think focusing on the risk calculation parts was smart.
Exactly.
We really get into how these regulations change how banks think about risk,
Absolutely.
which ultimately, impacts the whole global financial system.
Right. Makes everything more stable, hopefully.
Hopefully.
So let's jump right in, starting with the standardized approach for credit risk.
Sounds good.
Module 1 goes deep on how it works, but what are the key things someone should be watching out for?
Well, it's all about making sure banks have enough capital to cover potential losses.
Right?
But it's not just assigning a simple risk weight anymore. The sensitivities-based method uses delta, vega, and curvature to see how an asset's value could change based on market moves.
So they're trying to get a more complete picture of risk.
Yeah, because things don't always move in isolation.
They're interconnected.
Right, exactly.
Yeah.
And then you've got the default risk capital requirement and the residual risk add-on.
Right, those were interesting. What's the point of those?
They kind of address the limits of
Yeah.
even the most detailed calculations,
Okay.
The default risk capital requirement wants to make things fair.
Like a level playing field.
Yeah, making sure capital requirements are consistent for similar risks,
Got it.
or regardless of how a bank gets involved with those activities.
Yeah.
And then the residual risk add-on is like a buffer,
Like a just in case.
exactly, for those unexpected events that always seem to pop up.
Like we know we can't predict everything.
Right, a little bit of humility in the face of the unknown,
Humility, I like that.
even with all these fancy models.
Right. The guide also mentions some proposed changes specifically for claims on banks.
Oh, yeah.
These two approaches, external credit risk assessment and standardized credit risk assessment.
Right.
What's the practical impact of those, especially the bit about short-term claims getting a lower risk weight?
So it really comes down to who's deciding how risky something is. External ratings or a standard method.
Okay.
The lower weight for short-term claims between banks is strategic.
How so?
Well, it helps keep the interbank market running smoothly,
Oh, I see.
which is crucial for everyday banking.
Like keeping the engine oiled.
Exactly. Got to keep those gears turning.
Okay, so Module 1 is all about the standardized approach.
The nuts and bolts.
Yeah, but what about banks that use internal models?
Right.
That's where the IRB approach comes in, and Module 2 looks at what's next for that.
Yeah, the IRB lets banks use their own models if they have strong risk management.
Okay.
But as you pointed out, the Basel Committee is worried about it becoming too complex.
Like a skyscraper that's gotten too tall.
Yeah, exactly. Too hard to even keep track of.
So how do you simplify something like that?
Well, Module 2 is all about simplification and comparability.
Okay.
They want to make sure a bank's risk assessment actually reflects their risk profile,
Right.
not just manipulating the rules.
Oh, interesting.
There's a worry that the IRB might be encouraging banks to prioritize lower capital.
Over-accurate risk assessment.
Yeah, like getting a better score without actually being safer.
A bit like cheating in a marathon.
Exactly. Doesn't really work in the long run.
So how are they fixing this?
One way is this thing called the Regulatory Consistency Assessment Project, or RCAP.
Catchy name.
One specific thing they're focusing on is how banks define default.
Oh, that's interesting. So many ways to define that, I guess.
Yeah. Imagine if every bank had its own idea of what default means.
It'd be chaos.
Exactly. So the EBA, the European Banking Authority, is stepping in.
Okay.
They want a standardized definition so everyone's on the same page.
No more wiggle room.
Right. Makes it easier to compare risk across different banks.
That makes sense. But the guide says it's not just defining default, right?
No, there's also the issue of how they quantify risk.
Yeah, that seems tricky.
Different methods and assumptions can lead to totally different risk assessments.
Even for similar portfolios.
Yeah. Makes it hard to compare apples to apples, so to speak.
So how do you solve that? Make everyone use the same ruler?
Basically, yeah. The EDA is working on these things called Regulatory Technical Standards
Okay.
and Guidelines, or RTSs and GLs for short.
What do those do?
Think of them as like the official recipe for risk assessment.
It's interesting.
Everyone uses the same ingredients and steps.
Makes things more transparent.
Yeah,
Easier to compare.
Right.
But even if you've got standard definitions and calculations, there's still the issue of how to deal with assets that have already defaulted.
Ah, yes. Module 2 talks about that.
What's the key takeaway there?
Well, basically, the EBA hasn't given specific guidance on what to do with defaulted assets.
Oh, wow.
So banks are doing things differently, which can lead to big differences in capital requirements.
That's a pretty big loophole.
Yeah. Imagine if a bank could lower their requirements just by changing how they handle bad loans.
That wouldn't be fair at all.
No, not at all. So the EBA is planning to issue recommendations on this
Okay.
to provide some clarity.
Like a roadmap for dealing with defaulted assets.
Exactly.
So everyone's doing it consistently.
Yeah, exactly. Now, let's move on to Module 3. It tackles counterparty credit risk, or CCR.
Okay.
There's this new approach called SA-CCR.
SA-CCR?
Yeah, it's a pretty big change. For someone who already knows the basics of CCR, what's important here?
Got it. So walk us through it.
Okay, so counterparty credit risk, meaning the risk that the other side of your deal won't come through.
Right.
That's especially tricky with derivatives.
Because?
The amount you could lose changes all the time based on how the market moves.
Oh, right. Unlike a loan where it's more straightforward.
Exactly. Traditional methods don't really work for something as dynamic as derivatives.
So how does SA-CCR handle this?
It changes how we calculate exposure at default, or EAD,
Okay.
which basically tells you how much you might lose if the other party goes bankrupt.
Right.
It's similar to the current exposure method.
VCM.
Yeah, but it adds this thing called the alpha factor. That gets multiplied by the sum of replacement cost and potential future exposure.
Sounds complicated.
It is a bit, but the point is to make the calculation more sensitive to how much the derivative's value could swing.
So you're essentially trying to get a clearer picture of those potential ups and downs.
Exactly. You want to be prepared for the worst-case scenario.
Right. Always better to be safe than sorry.
Absolutely. Now, the guide also talks about how EAD is calculated under SA-CCR.
Yeah, there's a whole section on netting sets and what happens if there's no netting agreement.
Right. That's important because it affects how much you stand to lose.
Okay, break it down for me.
If you have a netting agreement,
Huh.
multiple transactions are treated as one,
Okay.
which can actually reduce your exposure if some gains and losses cancel each other out.
Like a built-in safety net.
Right. But if there's no netting agreement, each transaction is on its own.
Which means?
You could end up with a much higher EAD.
So netting agreements are definitely something you want to have in place.
Yeah, they can really make a difference if a counterparty defaults.
Now, I'm still a bit fuzzy on how SA-CCR is different from CEM.
Oh, okay.
Can you give us a quick comparison?
Sure. So CEM focuses mainly on current exposure, but SA-CCR considers collateralization.
Collateralization.
Yeah, like whether there's something pledged to cover potential losses. This gives a more realistic picture of how risk is actually being managed.
So it's not just about the raw exposure, it's about the safeguards that are in place.
Exactly. And speaking of collateral, the guide spends a lot of time on the RC component, replacement cost. That's part of the EAD calculation.
Okay.
And there's this big distinction between margined and unmargined transactions.
Why is that so important?
Well, margin transactions mean that the collateral is actively managed. It's adjusted to keep up with market moves.
Okay.
If the collateral isn't adjusted, it's treated as unmargined.
Even if it was posted initially.
Yeah, it's like having a security system that doesn't update for new threats.
Not very effective.
Not at all.
So dynamic collateral management is key.
Absolutely.
It provides a more responsive buffer against those potential swings in exposure.
Right. And the formulas used for calculating RC even take into account different collateral arrangements.
So they're really getting into the nitty-gritty of real-world collateral management.
Yeah, it's much more granular and nuanced than the previous methods.
Now let's talk about PFE.
Potential future exposure.
Right, that's the other side of the EAD coin.
Exactly. So both CEM and SA-CCR use PFE, but SA-CCR gets much more detailed.
In what way?
It calculates add-ons for each asset class. Interest rates, credit, equities, FX, commodities.
Wow, that's granular.
Yeah, it's like they're dissecting the risk assessment process, examining each piece of the portfolio.
To get a really clear picture of those potential future exposures?
Precisely. And this granular approach, while more accurate, also brings challenges.
Challenges.
Yeah, implementing SA-CCR is not a walk in the park, especially for banks used to the older methods.
What are the biggest hurdles?
Data, data, data. They'll need a lot more data than before on transactions, collateral, counterparties.
So it's not just about understanding the new math.
It's about having the infrastructure to support it.
To manage all that extra data.
Exactly. And this is a trend we're seeing across Basel IV. More granularity often means more data.
Okay, so before we move on to Module 4, let's quickly recap the key differences between SA-CCR and CEM.
Okay, so SA-CCR is definitely a step forward in how we assess counterparty credit risk.
How so?
It's more risk sensitive, especially when it comes to collateral. It's better at capturing netting and hedging effects,
Okay.
and it's more granular with those add-ons for each asset class.
But that comes at a cost.
Right. It's more data-intensive and more complex.
It's a trade-off between accuracy and simplicity, I guess.
Exactly. Banks need to weigh those factors carefully.
All right, let's dive into Module 4 now. This one explores how Basel IV is changing things for securitization and funds.
Yeah, it's about how capital requirements apply to securitized products and investments in funds.
Sounds complicated.
They are complex areas, but important to understand the full impact of Basel IV.
Like exploring the hidden parts of the financial system.
Yes, exactly. We'll see how these regulations affect the flow of capital in unexpected ways.
Okay, let's start with the basics then. What is securitization and how does the EU currently handle it?
Securitization is basically bundling up assets like mortgages or loans and turning them into tradable securities.
So you're slicing up a cake and selling the pieces.
Exactly. And this allows the originator to transfer the risk to investors.
Makes sense. Spreading the risk around.
Yeah, precisely. In the EU, this is mainly governed by the Capital Requirements Regulation, or CRR.
CRR, great.
It defines how we recognize significant credit risk transfer for traditional and synthetic securitizations.
Okay, so there's already a framework in place.
Yes, but Module 4 also talks about some criticisms of these rules.
Oh, right. What are the main issues?
The current framework relies too heavily on external credit ratings.
Which can be unreliable, especially during times of market stress.
Exactly. It's also not sensitive enough to risk.
Okay.
It doesn't really capture the specifics of different securitization deals.
It's like using a weather forecast that only tells you sunny or rainy.
Yeah, you need more detail than that to make good decisions.
So how do the Basel Committee's revisions address these issues?
They aim to reduce the dependence on external ratings and introduce new ways to determine risk-weighted exposure amounts.
So they're trying to make the assessment more granular.
Yeah, more tailored to the specific risks of each deal.
Makes sense. Moving away from that one-size-fits-all approach.
Exactly. And this focus on granularity is a recurring theme in Basel IV.
Okay, good to know. Now, the guide mentions a hierarchy of procedures in the Basel recommendations.
Right.
Can you explain how that works, especially for banks that have invested in sophisticated risk management systems?
Sure. So the hierarchy prioritizes different approaches based on how advanced a bank's risk systems are
Okay.
and whether external ratings are available. At the top is the SEC-IRBA approach,
SEC-IRBA.
which is similar to the current standardized approach, but refined.
So if a bank has a good internal model, it can use that to calculate its risk.
Exactly. It's a reward for good risk management practices.
Makes sense. But then there's a specific note for South African banks.
Oh, right. They can't use the SEC-IRBA approach.
Why not?
They don't have the necessary data inputs for it.
So they have to use different methods.
Yeah, either SEC-IRBA if they're external ratings,
Okay,
or SEC-SA if not.
got it. What about those really complex deals, the resecuritizations?
Those are always tricky.
Yeah.
They're treated under SEC-SA no matter what.
So even if there are external ratings available.
Yes.
Yeah.
Because they are just so complex, the Basel Committee is being cautious.
Better to be safe than sorry.
Absolutely.
Mhm.
Now, shifting gears a bit, Module 4 also looks at how these rules affect investments in funds.
Okay.
The guide specifically highlights the difference between the trading book and the banking book.
Right. Why is that distinction so important in the context of Basel IV?
It comes down to how capital requirements are applied.
Okay.
The Basel Committee is worried about banks using funds to avoid stricter rules that apply to trading.
Oh, interesting. Like trying to find a loophole.
Exactly. They could invest in a fund that does risky trading, but avoid holding the required capital.
So they're essentially outsourcing the risk.
Right, which defeats the purpose of the regulations.
Clever, but sneaky.
Yeah. So the revised framework tries to close that loophole
How so?
by introducing very specific criteria for classifying positions.
So it's no longer just about the bank's intent.
No, there's a list of what goes where, regardless of what the bank says.
That makes it harder to manipulate.
Precisely. And it creates a more level playing field.
Now, the guide does mention some exceptions to this strict classification,
Yes, but only with regulatory approval.
like in special circumstances.
Right. One example is equity investments in funds where daily monitoring or pricing isn't possible,
Okay, so the rules can be flexible if necessary.
but only with a good reason and oversight from the regulators.
Makes sense. So let's talk about what happens when a fund investment ends up in the trading book.
Okay.
What are the main things banks need to consider in that situation?
The biggest one is data.
Data.
Yeah. In the banking book, the asset manager or custodian handles the risk weight calculation.
Okay.
But if it's in the trading book, the bank has to do it.
Meaning?
They need more data, and they need it daily.
Wow, that's a big change.
Yeah, it can be a real operational challenge.
To gather and manage all that data.
Exactly, both for the bank and the asset manager.
So more transparency and more work.
Exactly. And on top of the data, there's another key condition for trading book allocation.
What's that?
You need daily real prices, or the ability to look through.
The sun.
Look through. Yeah, you have to be able to see the underlying assets and assess their value daily.
So even if the fund provides daily share values, it's not enough.
No, you need to be able to see under the hood, so to speak.
To make sure the valuation is accurate and reflects the real risk.
Precisely. Now, this could be tricky with funds that hold illiquid assets.
Because they're hard to value on a daily basis.
Right. If you can't get daily prices or look through, it might have to go in the banking book.
Even if it seems like it should be in the trading book.
Yeah, it's all about transparency and being able to assess the risk accurately.
Makes sense. Now, what about funds that are allocated to the banking book?
Okay.
How are the capital requirements for those exposures determined?
Well, the framework has rules for both the standardized and internal ratings-based approaches.
Got it.
They apply to both on-balance sheet exposures, like direct investments,
Okay.
and off-balance sheet exposures, like commitments to provide capital in the future.
So even if you haven't invested yet, your commitment still matters.
Exactly. It's about capturing the full picture of your potential exposure.
Makes sense. What about those really risky positions, the ones subject to a capital deduction?
Those are excluded from this framework.
Okay.
They're treated differently because they require a different approach to capital management.
Like they're in their own special category.
Exactly. Now, when it comes to calculating capital requirements under the look-through approach,
Look through, okay.
it's interesting to note that third parties can do the calculation.
Like the asset managers themselves.
Yeah, or custodian banks.
But there's a catch, right?
You got it.
Yeah.
A weighting factor gets applied, which generally leads to higher capital requirements.
So it's like having someone check your homework, but then adding some extra problems just to be safe.
Exactly. It's about adding a layer of conservatism.
Makes sense. Well, we've covered a lot of ground just in this first module alone.
Yeah, there's a lot to digest.
And this is just the beginning.
It is.
Yeah,
But it's important stuff.
definitely. Now let's move on to Module 5, which introduces a whole new framework for market risks.
Yeah, this is a big one. For someone already familiar with market risk management, what are the key takeaways?
Okay, so Module 5 focuses on refining how banks categorize their positions.
Trading book versus non-trading book.
Right, drawing a clearer line in the sand.
Exactly. And reducing the potential for banks to game the system.
Because different capital requirements apply to each book.
Right. And if you misclassify something risky, you could end up understating your true risk profile.
Like hiding the evidence.
In a way, yes.
Mm-hmm.
So the new framework makes the criteria much stricter.
And how does it do that?
It shifts away from relying solely on a bank's stated intentions and introduces objective characteristics of the positions themselves.
So it's not just about what the bank says they're doing with the asset.
Exactly. It's about the nature of the asset itself.
I see. Are there examples of how this works in practice?
Sure. Positions held for short-term trading or as part of market-making activities automatically go in the trading book.
No questions asked.
Right. The framework provides specific examples like this to clarify things.
So there's less room for interpretation.
Exactly. Now, let's talk about the revised standardized approach for market price risk.
Okay. How does that differ from the previous methods? What should someone already familiar with market risk management pay attention to?
The revised approach is called the sensitivity-based approach, or SBA.
SBA.
It provides a simplified method for calculating capital requirements,
Sounds good.
primarily aimed at banks with less complex trading operations.
But is it also relevant for the bigger players?
Yeah. It's intended to serve as a backup and a benchmark for everyone.
Oh, I see. So it's kind of a common reference point, even for those using internal models.
Exactly. And the goal is to improve the accuracy and comparability of market risk reporting.
But the guide mentions a bit of a contradiction here. The goal of simplicity versus increased risk sensitivity?
Right. It seems counterintuitive, but it actually makes sense.
Explain it to me.
Okay, so the increased risk sensitivity isn't about making things more complicated.
It's about...
Capturing a wider range of risk factors
Yeah.
in a standardized and transparent way.
Okay, I'm starting to see it now.
The SBA considers delta risk, curvature risk, vega risk, default risk, residual risk, and more.
So it's broadening the scope without getting lost in the weeds.
Exactly. Now on to the internal model approach.
Okay, the guide also talks about the rationale for revising that approach.
Right, and that rationale stems from some weaknesses exposed by the financial crisis.
Those weaknesses.
Some internal models weren't very good at capturing tail risks.
Tail risks, those extreme but rare events.
Exactly, the kind that can really shake things up.
Yeah, like a black swan event.
Right. So the revised framework implements a capital floor based on the standardized approach. This acts as a safety net.
So even if your internal model says you're good, you still need to hold a certain amount of capital.
Exactly. It's like having a backup generator in case the power goes out.
Makes sense. And even banks using internal models now need to calculate their capital requirements using the standardized approach as well.
Right. Dual calculation.
Yeah.
It's about ensuring comparability and acting as a check against model weaknesses.
So it's a way to make sure everyone is using the same yardstick.
Exactly. And it encourages banks to benchmark their internal models against a common standard.
Okay, I'm getting it now. It's about transparency, comparability, and a bit of healthy skepticism towards internal models.
Precisely. Now, for a quick rundown of the sensitivity-based approach, or SBA.
Okay, hit me with it.
The SBA considers a bunch of risk factors like delta risk, which measures sensitivity to the underlying asset's price.
Okay.
Curvature risk, which comes from the nonlinear relationship between options and the underlying asset.
Right.
Vega risk, which is all about changes in volatility.
And then you've got default risk and residual risk.
Exactly. They're trying to capture a wide range of potential market movements.
It's like a more comprehensive risk radar.
Exactly. Now let's shift to the internal model approach for market risk, or IMATB.
Okay, what's changed there?
Well, they've addressed some issues with the use of value at risk, or VAR.
Oh, yeah, VAR. What was the problem with that?
It has limitations like not being sensitive enough to those tail events we talked about.
Right, those extreme events.
Exactly. And it relies on a fixed 10-day holding period and a 1-year time frame for calibration.
Okay, and that might not be suitable for all assets.
Exactly. So the revised framework introduces some additional risk metrics.
To supplement VAR.
Right, like stressed VAR, or SVAR, which considers potential losses under really bad market conditions.
Stress testing, essentially.
Exactly. And then there's the incremental risk charge, or IRC.
And that's
capturing risks that VAR and SVAR might miss, like concentrated positions.
So it's all about adding layers of conservatism to the calculations.
Exactly. Recognizing that relying solely on VAR might not be enough, especially when things get rough.
Okay, that makes sense. Now, the guide also mentions that regulators have been concerned about discrepancies between internal models and the standardized approach.
Right. There have been some studies showing pretty different capital requirements for similar portfolios.
So different models are spitting out different answers.
Exactly. Which raises questions about the reliability and comparability of internal models.
Yeah, if different models are giving different results, it makes you wonder which one to trust.
Exactly. And to address this, the revised framework now requires all banks, even those using internal models, to also calculate their capital requirements using the standardized approach.
So everyone has to speak the same language, even if they're also using their own dialect.
Exactly. It's about transparency and creating a level playing field.
Now, let's dive into the procedural and organizational challenges of implementing the IMATB. The guide mentions some issues with defining a trading desk and getting approval to use the IMATB at the trading desk level. Can you shed some light on those challenges?
One challenge is assessing the bank's trading operations, like figuring out what constitutes a trading desk.
Right, because trading desks can be structured in different ways.
Exactly. And then you have to evaluate each desk's risk management capabilities.
So it's not just about the model itself, it's about the whole environment in which the model is being used.
Right. Regulators want to see evidence that banks understand the risks and have the right systems and processes in place.
So it's about culture, competence, and control.
Exactly. And getting approval to use the IMATB at the trading desk level is a pretty demanding process.
In what way?
Banks need to do rigorous backtesting, comparing the model's predictions to what actually happened.
Okay, so they need to prove that the model works in the real world.
Exactly. And they need to do profit and loss attribution analysis.
P&L attribution.
Yeah, to understand what's driving those profits and losses.
So it's about making sure the model is grounded in real-world trading experience.
Exactly. The approval process is designed to weed out models that are purely theoretical or unrealistic.
It's like a boot camp for risk models. Only the strong survive.
That's a great way to put it. Now, before we wrap up this part of our deep dive, let's recap those key indicators used to calculate market risk capital under the current framework.
Okay, remind us what those are.
We've got value at risk, or VAR, which measures potential loss over a given time with a certain confidence level.
Right.
Then there's stressed VAR, or SVAR, which considers potential losses under stress market conditions.
So a more conservative estimate.
Exactly. And finally, we have the incremental risk charge, or IRC,
What does that capture?
risks that VAR and SVAR might miss, like those concentrated positions we mentioned.
So it's like a safety net on top of a safety net.
Exactly. It's all about recognizing that VAR alone might not tell the whole story, especially in turbulent times.
So we've certainly covered a lot of ground in this first part of our exploration.
There's a lot to take in.
We've looked at credit risk assessment, market risk management, and the challenges of regulating complex structures like securitizations and funds.
It's all connected.
Absolutely. But this is just the tip of the iceberg. We'll pick up where we left off in part 2, diving into further revisions to the framework and their impact on the global financial system.
Looking forward to it.
Welcome back. We're continuing our deep dive into Basel V and in Module 6.
We're going to really get into the weeds of derivatives.
Definitely. The Credit Valuation Adjustment Risk Capital Charge Framework, or CVA.
Yes, CVA. So things get interesting.
Especially for folks who are already comfortable with the basics of derivatives.
Right. This is for those who are ready to take it to the next level.
So what are the key takeaways for someone like you when it comes to CVA?
Well, Module 6 is all about putting a number on the risk that the other party in a derivatives transaction might not hold up their end of the bargain.
So it's about recognizing that even a good trade on paper could go bad if the other side defaults.
Exactly. And the CVA is an adjustment that reflects that risk.
It's like factoring in the possibility that the person you're playing poker with might just run off with the pot.
That's a great analogy. You're putting a price tag on that risk of being cheated.
So we're talking about counterparty risk here, but the guide emphasizes that CVA is especially important for OTC derivatives.
It's their counter, yeah.
Why are those riskier than exchange-traded derivatives?
Because they're not standardized and there's no clearinghouse backing them up.
Okay, I'm following you.
With exchange-traded derivatives, you have the clearinghouse acting as a kind of intermediary.
Safety net.
Exactly. But with OTC derivatives, you're dealing directly with the other party.
So if they default, you're out of luck.
Right. There's no one else to step in and cover the loss.
It's like buying a used car from a stranger versus from a reputable dealer.
Yeah, there's more risk involved when you're dealing directly with the counterparty.
And that's why CVA is so crucial for OTC derivatives.
Exactly. It helps to quantify that risk and make sure banks are holding enough capital to cover it.
Makes sense. Now, the guide goes into how CVA is calculated, but it gets a bit technical. Can you break it down for us in a way that someone already familiar with the concepts would find useful?
Sure. It boils down to estimating the expected loss if the counterparty defaults.
Okay, that makes sense.
You need to consider a few things. First, the probability of default. How likely is this counterparty to actually default?
Right, and that depends on their credit worthiness.
Exactly. Then you need to estimate the recovery rate. If they do default, how much do you think you'll be able to get back?
So how much of the outstanding amount is salvageable?
Right. And finally, you need to figure out your potential future exposure.
Which means,
How much could you potentially lose based on how the market value of the derivatives might change?
okay, so you're not just looking at the current exposure, you're also considering how it might evolve in the future.
Precisely. It's about taking a dynamic view of counterparty risk.
And the guide provides that simplified example with two parties to illustrate how those elements come together.
Yeah, that example is really helpful for visualizing the calculation.
It shows how even a small probability of default can translate into a big loss if the exposure is large enough.
Exactly. And that's why CVA is so important. It helps banks to price that risk appropriately.
Now, let's dive into the specifics of the framework for CVA risk capital charges under Basel IV. It's called the FRTB CVA framework, right?
Yes. FRTB stands for the Fundamental Review of the Trading Book.
Right. That rings a bell.
So the FRTB CVA framework is all about providing a more comprehensive and risk-sensitive approach to calculating CVA capital charges.
More comprehensive and more risk-sensitive. What does that mean in practice?
Well, it means recognizing that counterparty credit risk is not static.
It can change over time.
Exactly. It fluctuates based on market conditions, the creditworthiness of the counterparties.
So the old ways of measuring CVA risk might not have been capturing the full picture?
Right. And the FRTB CVA framework aims to address those shortcomings.
And how does it do that?
One key innovation is the introduction of two different approaches for calculating CVA risk capital charges.
Two approaches.
Yes. We have the standardized approach, or SA-CVA, and the internal model approach, or IMA-CVA.
So banks have a choice.
They do. And this choice depends on the complexity of their operations and their risk management capabilities.
Okay, so tell me more about these two approaches. How do they differ?
The SA-CVA is more standardized and simpler to implement.
Okay.
It might not be as accurate or risk-sensitive as the IMA-CVA, but it's easier to manage.
So it's a trade-off between simplicity and accuracy.
Exactly. And banks need to choose the approach that's most appropriate for them, given their resources and their risk profile.
And of course, if they choose to use an internal model, they need to get approval from their supervisor.
Absolutely. Supervisors will scrutinize those models carefully to make sure they're robust and reliable.
They don't want banks using models that underestimate the risk.
Exactly. CVA risk was a major factor in the financial crisis, so supervisors are paying close attention to this area.
Now, the guide points out an interesting difference between how CVA is treated for regulatory capital calculations versus accounting purposes.
Right. That's an important distinction.
Can you explain that difference and why it matters?
Well, the Basel Committee wants regulatory CVA calculations to be consistent with accounting CVA calculations.
That makes sense, trying to keep things aligned.
Exactly. But the problem is that the accounting framework doesn't provide very specific guidance on how to calculate CVA.
So it's a bit of a gray area.
Yeah, which can create challenges for banks. They have to meet both regulatory and accounting standards.
Which might have different requirements.
Exactly. It's like trying to hit two moving targets with one arrow.
And this disconnect highlights the need for better coordination between accounting standard setters and regulators.
Absolutely. It would make everyone's lives easier if the rules were more harmonized.
Now, the guide digs into the basic CVA framework, which offers two options for calculation. The basic approach, BA-CVA, and the standardized approach, SA-CVA.
Okay, so we're getting into the nitty-gritty of the calculations now.
Yeah, walk us through those two approaches.
The BA-CVA is similar to how CVA capital charges were calculated before.
So it's a familiar approach.
Right. It's relatively conservative and straightforward.
Easy to understand and implement?
Exactly. The SA-CVA, on the other hand, is more complex.
In what way?
It uses a variance, covariance, and sensitivities model.
Sounds fancy?
It is. It can capture more nuanced aspects of CVA risk.
But it also requires more data and more sophisticated modeling techniques.
Exactly. So banks need to decide which approach is right for them.
Based on their portfolio complexity and their risk management expertise.
Precisely. And they can even choose to use different approaches at the netting set level.
So they can tailor their approach to different types of transactions.
Exactly. Gives them more flexibility to optimize their capital allocation.
Now, what about banks with smaller portfolios of non-centrally cleared derivatives? The guide says they can actually waive the calculation of both BA-CVA and SA-CVA.
Right. It's a way to reduce the burden on smaller institutions.
Okay, so what happens if they waive the calculation? How are their CVA risk capital requirements determined?
Their CVA risk capital requirements default to the sum of their counterparty credit risk capital requirements.
Yeah, it's a simplified approach that recognizes that the CVA risk is likely to be smaller for those banks.
Exactly. It's about proportionality, applying the appropriate level of scrutiny based on the size and complexity of the bank.
Now let's talk about hedging. Can banks use hedges to mitigate their CVA risk under the basic CVA framework?
Yes, they can. Both external and internal hedges are permitted.
What are some examples of those?
External hedges involve transactions with third parties, like buying credit default swaps to protect against counterparty default.
So you're essentially transferring the risk to someone else.
Exactly. Internal hedges involve transactions within the bank itself, like transferring risk between trading desks.
Okay, so you're diversifying the risk internally.
Right. But there are rules for how these hedges need to be structured and documented.
What are the key requirements?
For external hedges, they need to be closely correlated with the underlying risk.
So the hedge needs to be tailored to the specific risk being hedged.
Exactly. For internal hedges, the risk transfer needs to be genuine and effective.
So no shuffling risk around without actually mitigating it.
Precisely. And the eligible product types for hedging vary depending on the specific hedging strategy.
Can you give us some examples?
Sure. If you're hedging against changes in credit spreads, you might use credit default swaps or other credit derivatives.
Okay.
For interest rate changes, interest rate swaps or similar instruments.
So matching the hedge to the risk?
Exactly. It's about having the right tools for the job.
Now, the guide introduces this concept of the output floor. What is that all about?
The output floor is a minimum level of risk-weighted assets that banks need to hold for CVA risk.
Okay, regardless of which approach they use, BACVA or SA-CCR.
Right, it's a backstop to ensure a minimum level of capital is being held.
Like a safety net under the safety net.
Exactly. It's there to protect against models that might be overly optimistic.
Now, the guide mentions that there's no output floor constraint for the SA-CCR.
That's right.
Why is that? Shouldn't the more complex approach have a higher floor?
Well, the thinking is that the SA-CVA is already more sophisticated and risk-sensitive.
So it's inherently more conservative.
Exactly. The output floor is mainly there to safeguard against the limitations of the simpler BACVA approach.
Okay, I see the logic there.
It's about calibrating the safeguards to the level of complexity of the approach being used.
So we've talked about the benefits of these new CVA approaches, like the increased risk sensitivity.
Right, and the ability to capture the dynamic nature of counterparty risk.
But are there any downsides, challenges that banks need to be aware of?
One challenge is the broader scope of application.
Meaning?
More transactions are now subject to the CVA risk capital charge.
Okay, so more calculations, more complexity.
Exactly. This can be a burden for banks, especially smaller ones with fewer resources.
And it likely means investing in new systems and expertise.
Right. They'll need to adapt to handle these more granular and demanding calculations.
So it's a trade-off. You get a more accurate picture of CVA risk.
But it comes at a cost in terms of complexity and operational burden.
All right, let's move on to Module 7 now, which focuses on the new framework for large exposures.
This is all about preventing banks from getting too exposed to any single counterparty.
Or to a group of connected counterparties, right?
Exactly. Concentration risk is a big concern. It can amplify losses and even trigger a systemic crisis.
So it's about preventing those domino effects where one bank's failure brings down others.
Precisely. And that's where the large exposures framework comes in.
Now, before we get into the new framework, can you remind us how a large exposure is defined under Basel IV?
A large exposure is any exposure to a single counterparty or a group of connected ones
Okay.
that's equal to or greater than 10% of the bank's eligible capital.
So it's relative to the bank's size and capital base.
Exactly. Larger banks with more capital can handle larger exposures.
And as we've discussed before, eligible capital refers to the highest quality capital instruments,
Right. Primarily core equity Tier 1 and additional Tier 1 capital.
excluding things like Tier 2 capital, which is considered less reliable.
Exactly. The focus on high-quality capital is a key theme throughout Basel V.
It's about making sure banks have a solid foundation to absorb losses.
Absolutely. Now, the guide mentions that the Basel framework is mainly for international banks.
But that supervisors can extend it to other institutions.
Right, and that's what we typically see in practice.
So it's applied pretty broadly.
Yes. Most jurisdictions apply Basel rules to all banks, regardless of their size or international activities.
That makes sense. Creates a level playing field and prevents regulatory arbitrage.
Exactly. Everyone's playing by the same rules.
Now, let's talk about the upper limits on large exposures. How do those work?
The current framework sets an upper limit of 25% of eligible capital.
Okay, so that's the maximum exposure a bank can have to any single counterparty or group of connected counterparties.
Right. You can't go above that 25% limit.
So you have the 10% threshold that triggers monitoring.
Right. It's a warning sign.
And then the 25% limit acts as a hard stop.
Exactly. It's about preventing excessive concentration risk.
Now, the new framework introduces a lower upper limit of 15%.
Yes, but that's specifically for exposures between global systemically important institutions or GSIBs.
Okay, those are the two big to fail banks.
Exactly.
Yeah.
The ones whose failure could cause serious damage to the financial system.
And why the lower limit for them?
It's about reducing the risk of contagion.
Contagion.
Yeah. If one GSIB fails, it could trigger a cascade of failures throughout the system.
It's like a domino effect.
Exactly. And the lower limit is designed to make those dominoes less likely to fall.
So it's a recognition that the failure of a GSIB would have much broader consequences.
Absolutely. And the Basel Committee is even considering extending this lower limit to other systemic institutions as well.
So they're casting a wider net in terms of who needs to be extra careful about large exposures.
Right. Because interconnectedness isn't limited to just the GSIBs.
Now, what happens if a bank violates these limits?
They need to report it to their supervisor immediately.
And I'm guessing there are penalties involved.
Oh, yes. They could face fines, restrictions on their activities.
Maybe even lose their banking license in extreme cases.
Exactly. So banks have a strong incentive to stay within those limits.
Makes sense. Now, the guide mentions that the CRR's definition of large exposures and the upper limits haven't really changed.
Except for GSIBs, yeah.
Why is that? Why not tighten the limits for everyone?
Well, the initial focus of Basel was on those big multinational banks.
The ones deemed most systemically important.
Exactly. And those existing limits were considered sufficient for them.
Okay. But as we said, Basel rules are usually extended to all institutions.
Right. So it's possible we'll see adjustments in the future.
Maybe lower limits for other systemic institutions as well?
Yeah, it wouldn't be surprising. The regulatory landscape is constantly evolving.
All right, let's turn our attention to eligible capital for large exposures. We touched on this before, but can you elaborate on why certain capital instruments are excluded?
Sure. So eligible capital for large exposures is defined very strictly.
It's all about quality over quantity.
Right. It has to be capital that can absorb losses quickly and reliably.
So some of those subordinated capital instruments are out.
Yeah. Things like Tier 2 capital are excluded.
Because they're not seen as dependable as core equity Tier 1 and additional Tier 1 capital.
Exactly. They're not considered to be as loss absorbing.
So it's all about making sure that the capital backing those large exposures is rock solid.
Absolutely. And this is where the new framework goes even further than the CRR.
How so?
Tier 2 capital is no longer considered eligible capital at all.
Wow, they're really tightening the screws.
They are. It's a clear message that they want banks to have strong, high-quality capital buffers.
Now let's talk about how different counterparties are treated under the large exposures framework. Are there special rules for certain types of counterparties?
Yes, there are. While the general provisions apply to everyone, some entities get special treatment.
Okay, like who?
Central governments, banks, central counterparties, investment and securitization vehicles, for example.
So not all counterparties are considered equally risky.
Exactly. Some are seen as inherently safer than others, either due to their nature or their regulatory status.
Can you give us some specific examples of those exemptions or special rules?
Sure. Exposures to central governments, for instance.
Those are usually considered low risk
Right. They often get lower risk weights or even complete exemptions.
because central governments are unlikely to default.
Exactly. And that favorable treatment often extends to exposures that are guaranteed by central governments.
Okay, so banks are encouraged to lend to those entities.
Yes, because they're seen as safer bets. But exposures to other banks are trickier.
Because they're highly interconnected.
Exactly. The failure of one bank can quickly impact others.
So there are rules to mitigate that contagion risk.
Right, and those rules can vary depending on the jurisdiction and the specifics of the exposure.
Now, the guide mentions connected clients. Can you explain how that works?
So if you have multiple counterparties that are connected
Connected how?
through ownership, management, or economic interdependence.
Like shared suppliers or customers?
Exactly. They're treated as a single counterparty for large exposure purposes.
Okay, so you can't get around the limits by spreading your exposure across multiple connected entities.
Precisely. It's about capturing the true concentration risk.
And how do banks determine whether that connection exists?
They need to look beyond the legal structure.
Oh,
They need to consider things like ownership, voting rights, management influence, and contractual arrangements.
so they need to assess the substance of the relationship, not just the form.
Exactly. It's about looking at the bigger picture and applying the spirit of the rules.
Now, what exactly constitutes an exposure for large exposure regulations?
It's pretty broad. Basically anything that can lead to a loss for the bank.
So loans, securities, receivables, guarantees, letters of credit, derivatives, all of that.
All of it, both on-balance sheet and off-balance sheet items.
So they're considering all potential avenues for losses.
Exactly. It's a comprehensive approach.
Are there any exceptions, any exposures that are specifically excluded?
Yes, there are some. Low-risk exposures or those already covered by other capital requirements are often excluded.
Okay, give me an example.
Well, exposures to central governments, for instance.
Right, those are generally considered very low risk.
Exactly. And exposures fully guaranteed by those entities are often exempt too.
So it's all about focusing on the exposures that pose the greatest potential threat.
Right, those that could really hurt the bank if things go wrong.
The guide also mentions that intraday exposures on other banks are exempt. Can you explain that?
So, intraday exposures are those that arise from payments and settlements throughout the day.
Right, as banks transfer funds back and forth.
Exactly. And exempting them is about ensuring that payment systems can operate smoothly.
It would be disruptive to apply large exposure limits to those transactions.
Right. They're very short term and often have safeguards in place.
But the guide also mentions that the Basel Committee is watching these intraday exposures closely
Yeah, there's a recognition that the risks associated with these exposures might be increasing.
because everything is getting faster and more interconnected.
Exactly. So they might reconsider that exemption in the future.
Interesting. Now, how is the assessment base for large exposures calculated? How do you determine how much of an exposure actually counts towards those limits?
It depends on the type of exposure.
Okay, break it down for me.
For on-balance sheet items in the banking book, it's usually the carrying amount.
Net of any credit risk adjustments and impairments?
Exactly. So basically the book value of the asset adjusted for specific risks.
No. Like if you have a loan, you'd subtract any provisions set aside for potential losses on that loan.
Precisely. Now, for off-balance sheet items in the banking book,
Those are a bit trickier, I imagine.
they are. The assessment base is converted to a credit equivalent amount.
Using?
The conversion factors from the credit risk standardized approach.
Okay, so they're aligning the assessment base with the standardized approach.
Exactly. It creates more consistency across the framework.
And reduces the need for specific exceptions.
Right. We're seeing a move towards simplification and harmonization.
Now, what about counterparty risk? How does the new framework handle that for large exposures?
It uses the SA-CCR, the standardized approach for counterparty credit risk.
Oh, so the same approach that's used for CVA risk capital charges.
Exactly. Consistency is key.
And this is a big change from the current framework.
Yes.
Hmm.
It means the internal model method, or IMM, is being phased out for large exposures.
Everyone will be using the SA-CCR now.
That's right. It's all about standardization and reducing the potential for inconsistencies.
And this could lead to some significant changes in how counterparty risk is assessed.
Yes, the SA-CCR is generally considered to be more conservative than the IMM, especially for derivatives.
So banks that were using the IMM might see their exposure levels go up.
Exactly. They need to be prepared for that and adjust their capital plans accordingly.
Now, what about issuer risk items in the trading book?
Those need to be added to the same counterparty's banking book items for assessment against the large exposure limits.
So it's a consolidated view of the bank's exposure to that counterparty.
Right, taking into account both trading and banking book exposures.
And the existing methodologies for calculating risk-weighted assets for trading book items are still used.
Yes, for the most part. And offsetting long and short positions within the same issue is still allowed.
So if you have a long position and a short position in the same bond, you can offset them.
Exactly. But there are rules about offsetting positions from different issues of the same counterparty.
Okay, what are those rules?
The short position needs to be subordinated to or have the same seniority as the long position.
So the offsetting needs to be conservative, not creating any artificial reductions in exposure.
Precisely. And banks need to assign their trading book items to different seniority buckets.
Like a bucket for equity, a bucket for subordinated debt, and so on.
Exactly. It allows for more accurate offsetting.
And it's important to remember that this offsetting only applies within the trading book.
Right. You can't offset trading book items against banking book items.
They're separate silos.
Exactly. And that reflects the different risk profiles of those two books.
Now, what about credit derivatives? Can those be used to mitigate exposures in the trading book?
Yes, they can. But there are some specific conditions that need to be met.
Like what?
The credit derivative needs to be senior to or have the same seniority as the item it's hedging.
So you can't use a subordinated credit derivative to hedge a senior exposure.
Right. The protection needs to be at least as strong as the exposure it's covering.
And what's the other condition?
The hedged item needs to be included in the bank's exposure to the warrantor of the credit derivative.
The warrantor, the party selling the credit derivative.
Exactly. So you're essentially recognizing that you have an exposure to the warrantor as well as to the original counterparty.
Okay, so it's about capturing the full chain of risk.
Exactly. You don't want to create new exposures while trying to mitigate existing ones.
Now, to clarify something about those credit derivative hedged items, if an item in the trading book is hedged, is the secured amount deducted from the bank's exposure?
It depends on who the warrantor of the credit derivative is.
Okay, so tell me more.
If the warrantor is a financial institution, then yes, the secured amount can be deducted.
So if it's another bank or a regulated entity like that?
Right, because they're seen as more reliable, less likely to default.
But if the warrantor is, say, a hedge fund,
or a non-financial corporation.
then the bank can't deduct the secured amount.
Exactly. They still have to hold capital against the full exposure.
Even though it's hedged.
Right, because the quality of the protection matters.
Makes sense. It's like the difference between having a guarantee from a reputable company.
Versus a promise from someone you barely know.
Exactly. You wouldn't put as much faith in the second one.
Right. And regulators want to make sure banks are relying on solid forms of credit risk mitigation.
All right, let's zoom out a bit and talk about credit risk mitigation techniques more broadly.
Yeah.
Can banks use these techniques to reduce the amount that counts towards the large exposure limit?
Yes, definitely. The new framework allows for a variety of techniques.
Like what? Give me some examples.
Well, we've already talked about unfunded credit protection, things like guarantees and credit derivatives.
Right?
But there's also funded credit protection, where collateral is posted to secure the exposure.
Okay, so if a borrower pledges assets as collateral, that would reduce the bank's exposure.
Exactly. It provides a buffer in case the borrower defaults.
Makes sense. And what types of collateral are eligible?
It varies depending on the framework and the jurisdiction. But generally, it needs to be high quality, easy to sell if needed.
Liquid and readily enforceable.
Right. You want to be able to quickly convert it to cash without taking a big loss.
So cash or highly rated government bonds would be good examples?
Exactly. Now, to be recognized, these credit risk mitigation techniques have to meet certain standards.
They can't just be any old agreement, right?
Right. They need to meet the requirements of the credit risk standardized approach.
So it's not just about having a guarantee in place. It has to be a solid guarantee.
Exactly. The guarantor has to be creditworthy. The agreement has to be legally sound.
The value of the guarantee has to be sufficient to cover the potential loss.
Exactly. It's about substance over form.
And these same principles apply to collateralization under the internal ratings-based approach, or IRBA.
Right. The IRBA also has specific rules for collateral recognition, generally aligned with the standardized approach.
Can you give us some examples of collateral that's commonly used under the IRBA?
Sure. Mortgages on residential or commercial properties that meet the CRR criteria.
So those mortgages have to be properly registered and all that?
Exactly. And the loan-to-value ratios have to be within acceptable limits.
So it's all about making sure the collateral is low risk and has a stable value.
Right. It's about giving banks the flexibility to use internal models, but with conservative safeguards.
Now, when it comes to financial collateral, things like cash or securities, how do you calculate the eligible amount? The guide mentions a simple method and a complete method. What's the difference?
The simple method applies a fixed haircut to the collateral's value.
Yep.
That haircut is a discount to account for the risk that the value might drop.
So it's a safety margin.
Right. The complete method uses haircuts that are more tailored to the specific collateral and the counterparty.
More granular, as we've been seeing with so many other aspects of Basel IV.
Exactly. But it's also more complex and needs supervisory approval.
Because regulators want to make sure it's being used appropriately.
Right. Now, regardless of the method, the secured amount needs to be added back to the bank's exposure to the collateral provider.
Okay, explain that one to me. Why is that necessary?
Because you're essentially replacing one credit risk with another.
You're shifting the risk from the original counterparty to the collateral provider?
Exactly. And if the collateral provider defaults, the bank is still exposed.
So you have to consider their creditworthiness as well.
Absolutely. And if a bank uses the complete method for collateral, they also need to follow something called the substitution approach.
What's that?
It means replacing the original exposure with an exposure to the collateral provider.
Okay, so if a borrower pledges bonds as collateral, you replace the exposure to the borrower with an exposure to the bond issuer.
Precisely. It's about making sure the large exposure limits are applied consistently.
No matter who ultimately holds the risk.
Exactly. Now let's talk about exemptions. The current CRR and national rules allow for some leniency.
Like reducing exposure values or giving exemptions for low-risk stuff?
Right. But the new Basel framework is stricter.
Fewer exemptions.
Yes. Because one of the goals is to treat similar risks similarly.
So no special treatment just because of who the counterparty is.
Exactly. Less room for exceptions means more consistency and transparency.
And the use of those conversion factors for off-balance sheet items further simplifies things.
Right. It reduces the need for those specific exemptions that were there before.
So it's a win for clarity and simplicity.
Definitely. But there's one area where things are still unclear. Intergroup claims.
Intergroup claims, remind me what those are.
Claims a bank has on other entities within its own group.
Okay, so a loan from a U.S. bank to its European subsidiary, for example.
Exactly. The Basel study didn't really address how to treat those for large exposures.
So it's a bit of a gray area at the moment.
Yeah. We're waiting for more guidance on that.
Hopefully it'll be clarified soon.
Fingers crossed. Now, exposures to central governments and public sector entities, those are still exempt.
Okay, because they're considered low risk.
Exactly. As long as they meet certain criteria, the exposure is essentially risk-free.
So banks can lend to those entities without worrying about hitting the large exposure limits.
Right. But there are criteria to make sure those entities are actually low risk.
So it's not a blanket exemption. There are still some safeguards.
Absolutely.
Okay.
Now, onto another important concept. The look-through and transparency principle for risk positions in funds and securitizations.
Okay, what's that all about?
It's about looking beyond the immediate counterparty
Okay.
and understanding the underlying risks associated with the transaction.
Especially with complex structures like funds and securitizations.
Exactly. You need to pierce the veil and see who the ultimate obligors are.
So if you're investing in a fund that holds corporate loans,
You need to assess the credit risk of those individual companies.
not just the fund itself.
Right. The fund is just an intermediary.
So transparency is key.
Absolutely. It's about preventing hidden concentrations of risk.
And how does this look-through principle affect reporting, limit calculations, and connected client grouping?
It affects all of them.
Okay, give me the rundown.
For reporting, you need to disclose exposures to those ultimate obligors.
Not just the fund or securitization vehicle.
Right. For limits, those ultimate obligor exposures are aggregated and checked against the limits.
And for connected clients, those ultimate obligors are considered when grouping counterparties.
Exactly. It's woven into the whole framework.
Now, what if a bank can't identify all the underlying counterparties?
Then those exposures are assigned to the unknown customer group.
Unknown customer, interesting.
It's a conservative way to handle those situations where you don't have full transparency.
So you're acknowledging that there could be hidden risks.
Right. And this unknown customer group is treated as a single counterparty for large exposure purposes.
Okay, so you're essentially treating that lack of transparency as a risk factor in itself.
Exactly. Now, are there any cases where banks don't have to do this detailed look-through analysis?
I hope so. It sounds pretty intense.
There is an exemption. If the proportional investments in the underlying risks are small enough,
Small enough meaning?
less than 0.25% of the bank's eligible capital.
Okay, so it's a de minimis threshold. If the exposure is tiny, you don't have to go through the whole process.
Exactly. It's a pragmatic approach.
But what if the exposures are above that threshold?
Then you have to do the full look-through analysis.
Identify those underlying counterparties.
Yes. No shortcuts there.
So it's a risk-based approach, more scrutiny for the bigger, riskier exposure.
Precisely. Now, lastly, let's touch on regulatory reporting for large exposures.
What are the key requirements under the new Basel framework?
The new requirements are pretty much in line with what's already in the CRR.
So no big surprises there.
Right. The goal is to provide supervisors with a clear picture of large exposures.
To help them identify any potential vulnerabilities?
Exactly. Banks need to report all their large exposures, both before and after, credit risk mitigation, exemptions, and all that.
Okay, so it's a comprehensive view.
Yes, and they also need to report their 20 largest exposures, even if they're below the large exposure limit.
So regulators get a good overview of where the risks are concentrated.
Precisely. And because the requirements are aligned with the CRR, the reporting burden shouldn't increase too much.
That's good news. Now, let's move on to our final module, Module 8, which covers TLAC and MREL.
Yes, TLAC and MREL, key elements of the resolution framework.
Resolution, that's all about how to wind down a bank safely if it fails, right?
Exactly. Without causing chaos in the financial system or needing taxpayer bailouts.
Right. It's about protecting the system and making sure creditors, not taxpayers, bear the losses.
Precisely. Both TLAC and MREL are about ensuring that banks have enough loss-absorbing capacity to handle those situations.
Okay, so both are about ensuring banks can absorb losses, but what's the difference between TLAC and MREL?
TLAC is specifically for global systemically important banks, or GSIBs.
So TLAC is like MREL, but with stricter requirements for those systemically important banks.
Exactly. The consequences of a GSIB failing are much greater.
So they need a bigger cushion?
Precisely. Now, the guide refers to MREL as a new capital ratio. How is it different from the traditional ones, like the Tier 1 capital ratio?
Yeah, that confused me a bit.
Well, traditional ratios are about making sure a bank has enough capital for day-to-day business.
To cover losses from normal lending activities and such?
Right. MREL is specifically about having enough resources to handle a bail-in.
Bail-in, that's where creditors take a hit to recapitalize the bank.
Exactly. It's about making sure the bank can keep operating, even after big losses.
And ensuring that those losses fall on the bank's creditors, not on taxpayers.
Precisely. It's about making the system more resilient and reducing the need for government bailouts.
Now, how do you actually calculate MREL? What goes into that number?
It's a percentage of the bank's total liabilities and off-balance sheet exposures.
So it's a broader measure than traditional capital ratios, which focus mainly on equity.
Right. Because in a bail-in, a wider range of liabilities can be used to absorb losses.
So they're looking at all potential sources of loss-absorbing capacity, not just equity.
Exactly. And to be eligible for MREL, those liabilities need to be readily available to absorb losses.
Meaning?
They can be quickly written down or converted to equity if needed.
Okay, and they shouldn't encourage excessive risk-taking.
Right. You don't want to create perverse incentives.
Makes sense. Now, the guide emphasizes that MREL requirements need to be met both individually and on a consolidated basis.
Yes, both for the individual institution and for the group as a whole.
So the parent company and the subsidiaries all need to have enough bail-enable liabilities.
Exactly. It's a way to ensure that resolution can be conducted effectively at any level.
So who decides what these MREL requirements are? Who sets those targets?
In the EU, it's the Single Resolution Board, or SRB.
Okay.
They look at a range of factors: the bank's size, complexity, interconnectedness.
So bigger, more complex banks with lots of connections will have higher requirements.
Exactly. It's a tailored approach that reflects the specific risks posed by each institution.
Now, we've talked about MREL, but what about TLAC? How does that fit into the picture?
TLAC, remember, is specifically for those GSIBs, those globally systemically important banks.
Right, the ones whose failure could really rock the boat.
Exactly. TLAC is designed to make sure they have enough loss-absorbing capacity to be recapitalized in resolution.
So even if they suffer big losses, they can keep operating.
Right. It's about reducing the likelihood of a taxpayer bailout.
So TLAC is like a supersized version of MREL, tailored for those too-big-to-fail institutions.
That's a good way to think about it. The stakes are much higher with those GSIBs.
And both TLAC and MREL rely on a combination of own funds and eligible liabilities.
Yes, liabilities that meet certain criteria and can be bailed in.
The guide has a helpful table that summarizes those eligible liabilities.
It's a great resource for understanding the nuances of TLAC and MREL.
It breaks down which liabilities are eligible for each and which ones require contractual recognition of bail-in.
It's important to be aware of those distinctions.
Absolutely. Now, are there any assets or liabilities that are deducted when calculating MREL and TLAC?
Yes, there are. Things like investments in eligible liabilities of other institutions.
Or investments in the bank's own eligible liabilities.
Exactly. You deduct those to avoid double counting.
So you're making sure the numbers accurately reflect the true amount of loss-absorbing capacity.
Precisely. No inflating the figures.
Now, we've covered what MREL and TLAC are, but what about their practical impact on banks? What do banks need to do to prepare for these new requirements?
One crucial step is developing a solid recovery plan.
A recovery plan, okay. What does that entail?
It's a plan for how the bank would respond to a financial crisis.
How they'd get back on track.
Exactly. It needs to be detailed and credible, outlining specific actions for different scenarios.
Like a roadmap for navigating a crisis.
Exactly. And banks also need to provide a lot of information to the authorities.
Like what kind of information?
Information about their corporate structure, liabilities, business partners, geographic locations.
So the authorities have a clear picture of the bank's risk profile.
Right, and they can develop effective resolution strategies.
So transparency is key here.
Absolutely. Resolution authorities need to know what they're dealing with.
Makes sense.
Yeah.
Now, once MREL and TLAC are in place, are there ongoing monitoring requirements?
Yes, definitely. Banks will have to report regularly to show they're meeting their targets.
But the guide mentions some ambiguity about how that monitoring will work.
Right. There's still some uncertainty about the roles of different authorities in monitoring MREL compliance.
Because TLAC is a Pillar 1 requirement, so it falls under the regular supervisory process.
Exactly. But MREL's classification is less clear.
So is it a prudential requirement or a resolution requirement?
That's the question. But both types of authorities will likely be involved in monitoring.
And banks will probably have to submit regular reports.
Most likely, yes, to keep the authorities informed.
Now, how will MREL and TLAC impact how banks manage their capital and their funding costs?
One big impact is the focus on senior unsecured debt.
Because that's a key source of loss-absorbing capacity.
Exactly. Banks will need to issue more of it to meet their MREL and TLAC requirements.
So demand for this type of debt will increase.
Right. And that could push up funding costs.
Investors will want a higher yield to compensate for the risk.
Exactly. They know this debt could be bailed in if the bank fails.
So it's a new dynamic in the bond market.
It is. And the impact on funding costs will vary, but it's definitely something banks need to consider.
Now, the guide mentions that some banks might try to blame those higher funding costs on the legal disadvantages of bail-enabled debt.
Right, but that argument doesn't really hold water.
Because of the no creditor worse off principle?
Exactly. Creditors shouldn't be worse off in a resolution than in a normal insolvency.
So they might get a lower yield up front, but they shouldn't be unfairly penalized if the bank fails.
Precisely. Banks can't just pass on all the costs of MREL and TLAC to their creditors.
They need to manage those costs and make their debt attractive to investors.
Exactly. They need to show that it's still a good investment despite the bail-in risk.
Finally, let's wrap up with the disclosure implications of MREL and TLAC. How are these requirements likely to affect how banks disclose information to investors?
Transparency is going to be crucial.
More so than before.
Yes, because investors need to understand the risks associated with bail-enabled debt.
So what kind of disclosures can we expect?
Banks will probably have to disclose their MREL and TLAC levels,
Okay.
the composition of their eligible liabilities, their resolution strategies, and more.
So investors can see how prepared the bank is for a potential crisis.
Exactly. And those disclosures will need to be clear, easy to understand, and readily available.
No burying the information in the fine print.
Right. It's about building trust with investors and demonstrating a commitment to transparency.
Well, that brings our deep dive into Basel IV to a close. It's been a fascinating journey.
It has. We've covered a lot of ground.
From credit risk and market risk to resolution planning and disclosure.
It's a complex framework, but it's all about making the banking system safer and more resilient.
Absolutely. And hopefully our discussion has given our listeners a better understanding of what Basel V is all about.
I think we've provided a good overview of the key concepts and challenges.
And a glimpse into the future of banking regulation?
Exactly. It's an evolving landscape, and banks and investors need to stay informed.
Well said. Thanks for joining us on this deep dive into Basel IV. We'll be back soon to explore another exciting topic in the world of finance.